When we just take a look at REITs balance sheets, access to capital, they could access equity, debt, even increasingly joint venture capital. They're in a great position to really kind of embark on a growth opportunity in 2026.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. Today, I'm joined by two authors of REIT's 2026 REIT Outlook to discuss what's been on the minds of real estate investors, including valuation divergences, compelling opportunities, and global strategies. With me is Ed Pierzak, REIT's Senior Vice President for Research, and John Barwick, REIT's Vice President for Index Management and Industry Information. So, Ed, turning to you, before we look ahead to 2026, can you recap some of the major forces at play in the REIT space last year?
Yeah, 2025 was an interesting year. I think when we started the year, we had a very optimistic outlook for REITs. And in fact, REIT performance was quite strong, outperforming the broader market through April. And then some new trade policies came into the mix. And then in addition to that, we hit some other challenges throughout the year. We had some geopolitical tensions as well as the government shutdown. 2025 is really characterized as a year of uncertainty. We started off with our uncertainty measures. You could look at things like the probability of a recession, the VIX, even the BAA corporate spread. And we see that all those started low post Liberation Day. We did see that they hit a peak, but everything seemed to calm down by about mid-year. And then that actually carried through the end of the year. So in many ways, we are starting 2026 in a very similar position that we were in 2025. And again, we still have that optimistic outlook for REITs.
And Ed, how have REITs performed compared to the broader market as well as to private real estate?
So when we look at performance to the broader market, we really see that REITs underperformed in 2025. The broader market was well over 17%, and all equity REITs posted a gain a little over 2%. But that said, when we take a look at REIT operational performance, it's been quite good. And really, when we take a look at the recent, increase or surge in the broad equity market, much of that has to do with a tech rally. And that'll actually ultimately bring us to a little bit of a discussion about the divergence that we've seen between broad equity market and REIT market fundamentals or multiples.
All right, tell us a little bit more about those divergences and what you think that might set in motion for 26.
So as we sit in 26, we actually have dual divergences. And so on the one hand, when you use the term divergence, they can often be disruptive. But there's also often a silver lining that there can be opportunity in those divergences. And really, the first divergence we have is between the broad equity market and REIT valuation multiples. On the one hand, when we talk about whether a market is over or undervalued, oftentimes people move to a measure called CAPE. It's the cyclically adjusted price to earnings ratio. And when we take a look at the CAPEs for the S&P 500, we really see that they've been on an upward trend since 2023. And in fact, they are at fairly high levels. Again, when you look behind the curtain and dig a little deeper, you do see that this was driven mainly by tech stocks. And in fact, the Magnificent Seven is a portfolio of stocks that has really driven that number higher. In the same breath, we really see kind of a flat, cyclically adjusted price to FFO ratio for equity REITs. So what that all means is, on the one hand, some people may view the broad equity market currently as overvalued. Implication for that is really neutral to negative performance going forward. On the flip side, we see that REITs are likely undervalued and their outlook for future performance is quite good. So oftentimes when we see this kind of return back to equilibrium, we end up seeing that REITs outperform on a relative basis. Now, the other area where we see a divergence, and this in fact has been around since 2022, is a divergence between public and private real estate values. And we can measure this in really a variety of ways, but oftentimes we take a look at cap rates. And really what we see is that this divergence has now reached a record length, but the spread between cap rates still remains wide. But there is a little bit more of a nuanced story here. And on the one hand, when we take a look at the REIT implied cap rate, that's a market-based measure. On the private side, we actually have two measures. We have a private appraisal cap rate, which is based on estimations or the property valuation process. But we can also have a transaction cap rate. And interestingly enough, that really over the last year and a half or so, we see that the transaction cap rate and the REIT implied cap rate are really pretty much in sync with one another. And since that time, we've seen just kind of a flattening out of the appraisal cap rates. So in some ways, we're seeing that the appraisals really aren't recognizing the realities of the marketplace. So the gap remains wide. But again, here, the potential upside is that as this gap closes, we tend to see REIT relative outperformance compared to private real estate.
And Ed, can you talk a little bit about the steps that REITs have taken to position themselves in order to take advantage of potential growth opportunities in 26?
Yeah, as I said before, on the one hand, even though REITs may be a bit underappreciated in the equity markets, when we take a look at their operational performance, it's really been quite strong. They have operations that really have more or less kept pace with inflation. But in addition to that, when we look at balance sheets, we see that they're in great shape too. They've really exercised quite a bit of discipline when it comes to their balance sheets. They've maintained low leverage points. When we take a look at yields to maturity, they exceed 6 years. The average cost of debt is about 4.1%, so really akin to the current 10-year treasury. But probably most importantly, when we take a look at the debt, the vast majority is fixed rate, almost 90%. But then they're also big users of unsecured debt. And that unsecured debt is roughly 80% or so of total debt. And the unsecured debt really provides a bit of a competitive advantage, not only in efficient access to capital, but there's a cost advantage as well. So REITs are in a great shape for when the transaction market kind of heats up. And that's actually something that's worth noting. When we take a look at REIT transactions over time, it actually provides a little bit of a unique lens into the property market. And the reason for that is that REITs are really capital allocators. They're typically not dependent on the fundraising process. So they've been able to pull back on their transaction activities in bad times and accelerate those same activities in good times. And so in many ways, we can almost say that this measure or their net acquisitions is a bit of a harbinger of things to come. The good news is that we have seen recent upticks in REIT transaction activity. So we may see ultimately that the property transaction market is thawing.
Great. Ed, before I let you go, anything else in the report that you'd like to highlight in terms of what to expect for REITs in 2026?
Just a quick recap. Right now, we're facing dual divergences. And I think with those divergences, we have two opportunities, each one individual, that REITs can outperform either the broad equity market or the private real estate market. And then also, when we just take a look at REITs balance sheets, access to capital, they could access equity, debt, even increasingly joint venture capital. They're in a great position to really kind of embark on a growth opportunity in 2026.
Excellent. Thanks, Ed.
Thank you.
So, John, first off, how would you say global real estate has performed over the last decade?
Yeah, as measured by the Developed Extended Index, returns have been 4.8% over that time, led by North America with a return of 5.1%, developed Asia at 3.6%, and developed Europe at 1.5%. The industrial sector has led over that time with a return of 11.5%, followed by industrial office mixed at 7.1% and healthcare at 7.0%.
John, what did you see in 2025 with regard to global real estate performance?
Currency movements were a significant tailwind for U.S.-based investors.
In 2025, the U.S. dollar weakened against major currencies, including the euro and pound, which bolstered the performance of international assets. For U.S. investors, strong local returns in developed Asia and developed Europe were further boosted when translated back into dollars, which widened the performance gap with North America. In 2025, developed Asia led with a total return of 29.5%, followed by developed Europe at 21.2% and North America at 3.2%.
And what has NAREIT's analysis of actively managed global real estate funds revealed to date, John?
Active managers are overweight the U.S. compared to the developed index. And in 2025, active managers generally reduced their overall exposure to North America while favoring the diversified sector in Asia and retail in Europe. In 2026, we expect them to continue to strategically allocate investments in growing economies with strong real estate fundamentals.
And to what extent does NAREIT expect global REITs and publicly listed real estate to enable investment in today's modern economy?
We actually expect investors to increasingly recognize the important role global REITs and publicly listed real estate play in the modern economy. People get it when they realize how much of their daily lives are touched by REITs, from the logistics facilities that handle delivery of packages from online retailers, the telecommunications assets that enable mobile access to apps and online services, to the data centers that store our digital lives. People increasingly understand the importance of REITs in their daily lives and in the modern economy.
John, thanks so much for your time today.
Thank you, Sarah.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.